So Kroger has sped up its push into digital retailing, and the grocery store chain has adopted an omni-channel strategy, an integration of offline or in-store sales with online orders and logistics. A concept that began in China 6 years ago when the founder of Alibaba created the term new retail and then opened 300 high-tech supermarkets in 27 Chinese cities. Now we're seeing it at stores like Kroger, Target, and Walmart. This includes same-day delivery, restaurants in-store, app-driven sales, and QR codes. These changes, innovations, and business evolutions can have a major impact on overall sales, revenue, profits, net income, and these have the potential to make shareholders very, very happy in the long run as they see their stock market portfolios and overall net worth climb. So, the stock market historically can be a great way to build wealth and also a quick way to lose your shirt. And there are some important factors to consider before you go all in and dump every single dollar to your name in the stock market with the hopes of becoming an overnight millionaire. And although this isn't financial advice, I get asked quite often by clients about building wealth and generating great returns and ROIs in the stock market, especially now as they're extremely concerned with the safety of their money in the banks and are in search of safe places to stash their cash. And so I always have to qualify the would-be potential and often first-time investor with a series of questions. So I decided that it may be best to put this together in an easy-to-follow video to help thousands or possibly even millions more people out there with the same curiosity. So what are some of the most important and main reasons why you shouldn't invest in the stock market? Well, let's discuss that now. And if you would be so kind and invest in that like button, I would really appreciate it. Oh, and subscribe to the channel too, of course. Now, let's get right into it. So let's begin with an update as the Dollar Tree stock outperforms competitors on a strong trading day yesterday. So shares of Dollar Tree rose to $143.61 Friday on what proved to be an all-around great trading session for the stock market, with the S&P 500 index rising to 3752 and 3/4 and the Dow Jones Industrial Average rising to 31,082. Although Dollar Tree shares went up in value, they're still far below its 52-week high of $177.19. And confident investors in the brand will continue with their dollar cost averaging. I'm pretty sure they will. So, what are the main reasons why you shouldn't invest in the stock market? And Kevin, what is dollar cost averaging, or DCA? Well, first, let's get a better understanding for stock market investing. So stocks can be a valuable part of anyone's investment portfolio, and owning stocks in different companies can help build savings, protect your money from inflation and taxes, and maximize income from your investments. So if any of these don't interest you, then I would take that as a sign that I shouldn't invest in the stock market. And what is dollar cost averaging? Well, before we get too far ahead of ourselves, I think that it's important to know that there are risks when investing in the stock market. And like any investment, it helps to understand the risk and the return relationship and your own tolerance for that risk. So we will pick back up on this. But first, I want to share an important update that the mega grocery chain Kroger has recently shared. So Kroger has sped up its push into digital retailing, and the grocery store chain has adopted an omni-channel strategy, an integration of offline or in-store sales with online orders and logistics, a concept that began in China 6 years ago when the founder of Alibaba created the term new retail and then opened 300 high-tech supermarkets in 27 Chinese cities. Now we are seeing it at stores like Kroger, Target, and Walmart. This includes same-day delivery, restaurants in-store, app-driven sales, and QR codes. All these ideas originally came from China, according to a CNBC News article. Now, Amazon led the charge in the U.S. after Jeff Bezos bought Whole Foods Market in 2017 and began introducing several advanced technologies to streamline in-store shopping, and that shift quickly spread to large retailers like Walmart and Target. And Kroger's new retailing links together shopping, e-commerce, and logistics with automated fulfillment centers, bagging groceries, while vans are making same-day deliveries to households, and data analytics are providing an early read on customers' trends, while mobile apps distribute customer promotions and coupons. They have ghost kitchens, which prepare meals for in-store pickup or van delivery, while QR codes handle payments online and at self-checkouts. And Kroger's large online fulfillment centers and warehouses rely on robots for packing, sorting, and loading orders. So the new automated fulfillment centers are a critical part of the technology effort. These centers use AI and robotics to replace labor-intensive work of sorting and bagging groceries for delivery, while on-site employees handle such operations as engineering and inventory management. Michael Zakor, founder of digital commerce and retail consultancy 5 New Digital in New York, said that when you look at retail, there are two big enablers: tech and data science, and secondly, supply chain logistics and fulfillment. And that American retailers are learning that their operations can be more efficient with higher margins when retail and e-commerce are seamlessly integrated. So while Kroger has been one of the more progressive U.S. retailers in implementing this omni-channel approach, competitors like Walmart and Target are spending heavily, even in a slowing economy, with technology as their primary focus, trying to play catch up. Kroger's digital business scaled to more than $10 billion in 2020 and has grown by 113% during the past 2 years. Take a look at this chart. So building on this momentum, Kroger aims to double its digital revenues by the end of 2023. And I would not be surprised to see this stock continue to trend upward as Kroger continues to invest in technology, online ordering, and home delivery. So I'm sure that there are dollar cost averaging investors out there that are happy to see these gains from Kroger's stock performance. So there's those three words again: dollar cost averaging. Kevin, what does that mean? So according to Investopedia, dollar cost averaging is an approach to purchasing an investment in which the buyer spreads out their purchases so that the total price paid is less affected by the market timing. And while investing can be challenging, even experienced investors who try to time the market to buy at the most opportune moments can come up short. Dollar cost averaging is a strategy that can make it easier to deal with uncertain markets by making purchases automatic, and it also supports an investor's efforts to invest regularly. So with that being said, I would then have to ask myself, am I looking to time the market? Am I not interested in investing regularly by possibly setting up automatic stock purchases? If the answer to either one or both are yes, then I would take that as a sign that I shouldn't invest in the stock market. So I personally prefer to follow the lead of those who have come before me, have had tremendous success, and continue to lead by example. Let's use Warren Buffett, for example. The Berkshire Hathaway CEO is arguably the world's greatest stock investor and has a net worth somewhere in the neighborhood of about $96 billion. And he has said that rule number 1 is never lose money. And rule number 2 is never forget rule number 1. So what that basically boils down to is achieving the mindset of smart investing. Don't be frivolous and don't gamble. And the best ways to avoid these portfolio killers is to be informed and do your homework. So Warren Buffett only invests in companies he thoroughly researches and understands. He doesn't go into an investment prepared to lose, and I wouldn't either. And so I would then have to conclude that if you're not willing to gather information, do your homework, and become more educated in the companies you want to invest in and buy shares of their stock, then I would take that as a sign that I shouldn't invest in the stock market either. I'm of the similar opinion of Warren Buffett and his philosophy of our favorite holding period is forever. Warren Buffett says that if you don't feel comfortable owning a stock for 10 years, you shouldn't own it for 10 minutes. Traditionally, a long holding period will keep an investor from being too fearful or too greedy, which can cause investors to sell stocks at the bottom or buy at the peak and ultimately destroy their portfolio's appreciation for the long run. Buy and hold is a passive investment strategy in which an investor buys stocks or other types of securities such as ETFs and holds them for a long period regardless of fluctuations in the market. Conventional investing wisdom shows that with a long time horizon, equities render a higher return than other asset classes such as bonds. There is, however, some debate over whether a buy and hold strategy is superior to an active investing strategy. And while both sides have a valid argument, this is a basic general example of the qualifying questions when trying to determine if you shouldn't invest in the stock market. And according to Investopedia, Buy and hold investors tend to outperform active management on average over longer time horizons and after fees, and they can typically defer capital gains taxes too. Now, if you're saying to yourself that you just aren't cut out for investing in the stock market, but are still really interested in the benefits that can come from having a long-term and diversified investment portfolio, then there is still good news. You can hire a pro, compare investment advisors in your area, or even search online. Everyone can invest in the stock market, and you don't have to be an expert to do it either. If you would like more information and future videos on investing in the stock market and building investment portfolios, as well as different types of investment strategies, dividend returns, and a closer look into my personal investments, just let me know. If I get enough comments showing interest in those videos, I'll be sure to make them. And make sure you check out this video here and this playlist, subscribe to the channel, and I'll see you guys real soon. Take care. Be safe. Bye.